Around the world, there's so much money made illegally. They're hidden away in fake accounts, mostly in the secretive Swiss banks. It belongs to big businessmen, politicians, criminals, terrorists, etc. Now, the Switzerland gives banking secrecy. But is there any country in the world that will allow these funds to be secretly invested, make a profit, and also exit without paying any tax for the profit made? Sound crazy, right? But it's true that there is one country in the world that allows you to do just that. Yes, that country is India. This unique channel for investing in the Indian stock market is called participatory notes, or in short SPI notes. Here the foreign investor, without disclosing their identity, can invest in the Indian stock and also take back their profits without paying any tax. Because of this, India was able to attract billions of dollars of investment. The money that came through this route provided the much needed capital for Indian companies to grow and expand their business. But why is India, the third largest economy in the world, offer such an option? To answer this question, a bit of India's history must be recalled. After India's independence in 1947, India adopted socialist pattern of economy as majority of its population was living below the poverty line. Big private investment was discouraged in favor of state-controlled institutions. Most of the big private businesses like banks, airlines, etc. were nationalized. Foreign companies were allowed but harassed. Example, the soft drink company Coca-Cola was forced to leave India in 1977. The government adopted the 5-year plan model of the Soviet Union and set up a body called Planning Commission. The USSR was India's largest trading partner. This period was also nicknamed the License Raj because for all private business activity, license was required. Powerful Indian politicians and bureaucrats called the shots. As a legacy of that period, the Indian government even to this day runs around 365 businesses called Public Sector Units or PSUs. But by the late 1980s, it was clear that the India's socialist economy was a big failure. The last nail in the coffin was a complete dissolution of the Soviet Union in 1991. India's largest trading partner was gone, and now India was heading towards its bankruptcy. India had only 1 billion in forex reserves, barely enough for 2 weeks of imports. It was at this time India approached the IMF for a bailout. The IMF agreed for a bailout, but with one main condition: the state-controlled economy must now be liberalized. India's then Finance Minister, Mr. Manmohan Singh, understood the gravity of the situation and convinced the then Prime Minister, Mr. Narasimha Rao, to liberalize the economy. So in 1991 finance budget, Mr. Singh liberalized the economy. He eliminated the License Raj and removed all obstacles standing in the way of foreign direct investment. He initiated the privatization of state-controlled businesses and established SEBI, Securities and Exchange Board of India, the Indian stock market regulator. He also created 2 ways by which foreign investors can invest in India. The first is the FDI, or Foreign Direct Investment. Here a foreign investor invests directly into the equity of a company in India. Assets are created and foreign investors can become a stakeholder in the company. This is a long-term investment and this investment is not liquid. The second route is the FII, or Foreign Institutional Investors route. This is a stock market route where the foreign investor invests through a SEBI-registered FII for buying and selling stocks listed in the stock exchange. The foreign investor can make a profit and exit his investment with a few clicks of his mouse. This route would later become the most favored route for foreign investors. FIIs can be a hedge fund, bank, mutual fund, etc. As of 2022, SEBI has over 1,450 registered FIIs in India. In spite of the Indian government doing so much, there was a problem. The world did not immediately believe in India's opening up of the economy for foreign investors and was viewed with suspicion. Hence, from 1991 to 2000, foreign investment did not automatically pour in. India had to do more to muster confidence in foreign investors. Hence, SEBI, the market regulator, came up with an ingenious plan. The present situation was that if any investor anywhere in the world wanted to invest in the Indian stock market, he or she would have to first obtain a PAN card, which is the Indian tax number. Then we'll have to open a demat account in India to buy and sell shares in India. This was a very cumbersome process and hence was an obstacle. To overcome this hurdle was born the participatory notes or P-notes. P-notes were introduced in the year 2000. Here the foreign investor need not get a PAN number or open demat account, but must register themselves with a foreign institutional investor, which are in turn registered with SEBI. Now the foreign investor just needed to transfer the funds to the FII and provide instruction on which of the shares of the companies needed to be purchased. The FIIs will then buy the requested shares in the Indian stock market, and for the investment made would provide a P-note to the investor. Now here the identity of the investor is known by the FII but is not required to be revealed to SEBI as per the new law. SEBI will also not ask for the investor details to the FII. Hence the anonymity and secrecy is maintained. For this reason, the P-note investors were jokingly called the faceless investors. But it was a big hit. Funds began to pour into the Indian stock market. SEBI achieved its objective of instilling confidence of the foreign investors in the Indian stock market. Foreign investments began to pick up, and so was the participatory notes. Participatory notes as a percentage of total foreign investment began to climb and reached its peak in 2007, where it constituted almost 55% of the total FII. This means 55% of the foreign investment in India was anonymous or faceless. In India, participatory notes drew criticism from all quarters of the political spectrum. The ruling Congress party was accused of providing patronage to criminals and terrorists who would also be investing through this route. The Indian media, which is forever on the lookout for sensational news, began rolling out different conspiracy theories on the participatory notes. The most widely circulated theory is that Indian politicians, big businessmen, Bollywood stars and sportspersons made a lot of money, but India was largely a cash-based economy and very few people pay income tax. To hide the black money, as it was called in India, corrupt Indian politicians, with the help of Hawala operators, carved out a way to transfer funds out of India to the secretive Swiss banks. The Swiss bank was a favorite destination simply because of the privacy it provides. But there was a problem. Even though Swiss banks provided the much needed secrecy to its deposit holders, it deducted 2% interest on all deposits as charges. Normally in India, banks provide 3 to 6% interest to its customers. But the Swiss banks were doing the opposite, deducting 2% from its depositors, which means depositors would lose 10% of their deposit in just 5 years. Indians were on the lookout for another solution. When participatory notes were introduced, it was an irresistible option for Indian Hawala money. Anonymous and at the same time make huge profits in the Indian stock market. Let me give you an example. In March 2022, Axis Bank declared ₹1 dividend for every share. Now the FIIs hold 139 crore shares in Axis Bank, which means the FII made ₹139 crores or $17 billion in dividend income alone this year. The Indian stock market is a cash cow. As a percentage of P-notes increased, there was wide protest. So to calm the nerves, on 16 October 2007, when the P-notes touched the peak constituting 55% of the FIIs, the SEBI proposed a ban on the participatory notes. This sent shockwaves, and on the next day, on 17 October 2007, within a minute of opening for trade, the BSE Sensex crashed 1,744 points, or about 9% of its value, the biggest intraday fall in the Indian stock market in absolute terms. This led to an automatic suspension of trading for an hour. The Indian government sprung into action and rolled back the decision to curb the P-notes. Things came to normal only after the then finance minister of the time, P. Chidambaram, issued clarification that the government was not against the FIIs and was not immediately banning the P-notes. There is also another interesting aspect of the P-notes. If you look at the 2022 list of countries from where the foreign investment is coming, the majority is from the US. But at the second place, we have Mauritius. Mauritius is a bunch of small islands in the Indian Ocean with a population of just 12 lakhs or 1.2 million people. But why is so many investment coming from here? This is because when foreign investors sell their share in the Indian stock exchanges, they are supposed to pay a capital gains tax of 20% on their profit. But for investments coming from companies registered in Mauritius, capital gain tax is zero. The same holds true for Singapore and Luxembourg, countries with which India has signed treaties as not to levy capital gains tax. The P notes then continue to exist, but its percentage share reduced to about 10 to 15%. This continued for another 6 years until 2014, after which the P note share in overall investment started dropping drastically, and by 2019 its value dropped to just 1.8% of the overall FIIs. So what happened in 2014? In this year, a new government under Prime Minister Modi came to power. After this, SEBI tightened the grip on P notes and rolled out some strict rules. First, SEBI made it compulsory for the FIIs to share the identity of the investors holding P notes to SEBI every 3 months. Secondly, SEBI banned P notes from derivative trading. The third was the most important. Hedge funds, the main route taken by the foreign investors, was banned from issuing P notes on their own. Now they can only buy P notes from other KYC compliant FIIs. That was a brilliant stroke by SEBI. P notes was not banned, but its glare and attraction was reduced. The next was a problem with investment coming from Mauritius. In 2016, the Indian government amended the tax treaty with Mauritius. Only companies registered in Mauritius with a net expenditure of Rs 27 lakhs in Mauritius in the preceding financial year is eligible for waiver of capital gains tax. Hence, shell companies with just postal address in Mauritius is eliminated. In years to come, more stringent amendments are to be brought out so that nobody can misuse the Mauritius route of investment. Foreign investment is very important to India's growth. For this reason, FIIs continue to dominate the Indian stock market sentiments. The Indian stock market swings with the FII inflows and outflows. While the FIIs are encouraged to bring in more funds, the misuse of privileges will be dealt with strongly. India will no longer be a place to launder money. If you like this video, please subscribe for more. Thanks for watching.